Live from Sydney, I'm Stroud-Watts. This is Insight, where we dive deeper into the stories that matter with crucial context and sharp analysis. Well, Asian stocks are rallying after softer US inflation trims Fed rate hike bets. Tech shares leading gains. South Korea's Kospi jumping as SK Hynix surges on AI optimism. Oil extends gains for a third straight session after President Trump threatens further strikes on Iran and reimposes its blockade on Tehran's shipping. PIMCO sees opportunity across fixed income as higher yields improve valuations. Core Strategies CIO Mohit Mittal will tell us more about how the firm's selective interest in AI-linked financing. Can Japan become the leading destination for foreign capital in Asia? Amova Asset Management CEO Stefanie Drews joins us in the hour to discuss that market's appeal. And the 2026 FIFA World Cup is on track to become the most lucrative sporting event in history, with more teams, more matches, even a halftime show. James Walton, who leads Deloitte's APAC Sports Business Group, will be joining us to explore how FIFA has moved the financial goalposts and scored. We'll take a look after what has been a pretty challenging start to the week for equity markets across Asia. We are seeing that rebound really being led by South Korea. Of course, we've had 2-3 really difficult sessions for the market leader SK Hynix there, but we are seeing that sort of AI revival play rotating back into favour in today's session. We also have some interesting, if not somewhat bifurcating data out of China. The GDP numbers are obviously missed, but there were a couple of points of optimism there where we had the GDP deflator coming out of that deflationary spiral for the first time in about 3 years there. Retail sales was also a bit on expectations, but as I mentioned, the GDP numbers missing expectations. There's concerns that perhaps that reflation effort is really being concentrated on certain sectors of the economy like oil as well as AI, but also at the moment we're looking at that continued malaise in the property sector. Property investment plunging by 18%, the most since 1992 there. But if you take a look across the region, it is a pretty buoyant day as we see Hong Kong stocks there trading upwards. We are seeing Kospi, that optimism playing out, and across the rest of most Asian markets there as well. The outlier, of course, is what we're continuing to watch when it comes to tensions in the Middle East. We've got that 20% threat from President Trump on the Strait of Hormuz off the table for now, but there are yet more threats of potentially more military action to come in the next week. We have just heard that the US Central Command completed another additional round of strikes against Iran for the day, with military targets around the coastal area and Strait of Hormuz among some of those targets. We're also watching the Fed, of course, not least of which is the inflation numbers, but also some of the comments from Kevin Walsh in terms of where the Fed is at in its fight against inflation.
If we get policy right, and I can assure you we will, the inflation surge of the last 5 years will be a thing of the past. The members of our committee have no tolerance for persistently elevated inflation, and we share a resolute commitment to ensure price stability.
Let's bring Edward Reynolds, who leads our Markets Live Asia coverage. So obviously very carefully calibrated statement. A lot of optionality there in terms of the tools that the Fed still has. Do you think it brought us closer to more certainty that he thinks that more tightening needs to happen?
It was baby steps in that direction, and I think it would have had quite a severe impact on the market if the June CPI data that came out in the hours before he spoke had beaten to the upside instead of coming in softer than expected. So instead, he reinforced the message that the Fed is likely to, everybody's expecting the Fed will hike rates at some stage this year. So that kind of became more certain, even as the immediate data pushed traders to remove any expectations that it would come this month. And in fact, they're not fully pricing in a hike until the December meeting. So that aligns pretty well with what Walsh is saying. I think it also sets up some potentially difficult days ahead for bonds and for stocks, because the most likely course is that those bets on an earlier move than December are going to come in more strongly.
Which is also difficult because who knows where we'll be when it comes to energy prices by December, right? The war, the ongoing threats from President Trump, even if the 20% rate is off the table for now, as you said, it makes it all very difficult.
Yeah, well, I mean, I think the risks are more tilted to the side of higher inflation that investors are accounting for. There's a couple of things going on there. One is that even if you look at the recent escalation mostly being about rhetoric, we're not getting the kind of attacks that we got back in March and April. It is still acting as a delay on when you might get peace or something approaching peace. So that delays the full resumption of crude flows. Also, investors risk looking at the wrong oil price because fuel prices are staying much higher and look like staying much higher for longer relative to crude. That's partly because there are refineries that are cut off in the Gulf or have been damaged in the Gulf. It's also a lack of refining capacity globally, and in particular, what Ukraine has been doing to Russia's refineries is acting to keep a lot of supply of refined products off the market. And refined products that's what you put in your car and your generator. That's what is going to have an impact on inflation numbers in the real economy. And in fact, the soft June data was a reminder of that because gasoline prices dropped in June. That was the immediate impact of the ceasefire. Those prices will be coming back up now that we've got what's going on in Russia, now that we've got a resumption of hostilities in the Gulf.
The other thing that we're watching, which has been quite interesting, I mean, the China data is always interesting, right? But there's a lot of kind of bifurcation in what we're watching today. There were, to be fair, a couple of points of positivity.
Yes, I mean, in particular, the monthly numbers showed that industrial production and retail sales came in much stronger than expected. And we've got the potential for some diversification within Chinese equities precisely because of that. With consumer firms are doing pretty well. We already had a strong bifurcation towards Chinese AI plays doing well. That's likely to go on with the DeepSeek IPO news that came out and the general trend towards the cheaper and competitive Chinese AI products at a time when the doubts about the more expensive US-based AI providers, whether those can go on justifying the amount of expense that's being slated to both to buy the chips and the data centers that are needed to run those programs.
Garfield Reynolds, who leads our Markets Live Asia coverage there. And joining us now from Singapore is Mohit Mittal, who's a CIO of Core Strategies at PIMCO, of course, one of the world's largest fixed income and active bond fund managers. Mohit, really great to have you with us. And let's pick up on the China story, right? Are you convinced that the deflationary spiral is over, given that we have that deflator coming out for the first time in about 3 years?
Thanks, Heidi. Thanks for having me. I think to the China question, we don't think that the deflationary export from China, the export of deflation is necessarily over. I think the growth numbers are weaker than expected. At the same time, what we are seeing is that the production or the manufacturing remains strong, whereas the consumption is on the weaker side. And what that means is that more exports out of China. You've seen the auto export data more recently. For example, the June numbers of over 1 million car exports out of China, bringing kind of likely trend for 2026 to over 10 million. And I think that trend continues. And I think that feeds into a little bit of a deflationary impulse to the rest of the world because of what is happening in China.
The retail sales numbers in particular were interesting to me because, of course, so much of the drag has come from the domestic consumption side. Is there a sense that the themes, the investment themes around the Chinese consumer and domestic demand might be improving?
I think at the margin, certainly yes. But I think the bigger picture with respect to China is just this ongoing transition whereby the economy is transitioning to a more kind of basically high-tech manufacturing, AI, technology, and those sectors will continue to do well. Consumption, while it has improved a little bit, remains on a kind of a weaker trend. Same with the property data, you saw that coming out weaker. So in aggregate, I think the focus on China will be this high-tech manufacturing, AI, and then basically more production and export in that sector.
You've talked about not sort of stepping away from just a broad directional bets for or against Chinese assets, right? Particularly in the absence of more broad-based fiscal stimulus or even PBOC stimulus from the old playbook. How do you invest around China there in terms of what the selective opportunities might be?
Yeah, I think the opportunity set with respect to China has less to do with the Chinese fixed income opportunity sets where the yield is pretty low, and you might have a little bit of a rate cut, 10 bip here and there. The opportunity set because of China stems in broader fixed income markets, and I think when we look at it, broad fixed income markets globally, what we find is that the aggregate yields across the globe have moved higher. Market is pricing sustained inflation in many parts of the world. US, Europe, Australia, UK, even Japan. And I think what's happening in China, again, kind of points towards a little bit of a disinflationary impulse to the rest of the world, thereby supporting the opportunity set in the rest of the world. With respect to China in particular, I think certainly like investments tied to the sectors that are in the focus as part of that transition with respect to high-tech, chips, AI, those will be an opportunity set for investments. But in the fixed income space, broadly, the opportunity set is outside of China in the global diversified fixed income markets, which look very, very attractive because that allows us to construct portfolios at about 6.5%, even 7% yield that offer a lot of value to investors.
It's interesting, I think the last time we spoke, you said the likelihood is that you think the Fed will stay on hold until the end of the year, that inflation will moderate. A couple of things, I guess. Has the commentary from Fed Chair Walsh overnight changed that at all, or sort of changed that calculus? And has the now reignition and re-escalation of the war changed that?
Yeah. So I think with respect to the Fed, our view is that the Fed will remain very data dependent. They will focus on a couple of things. One is around inflation, second, inflation expectations, and then third, incoming economic or macroeconomic data. And I think when we look at that on a forward basis, our view is that the data will likely support Fed to keep rates on hold in the near term. Inflation, while in the near term, energy price is having an impact upward on inflation, the consumer side of it is not as strong. Thereby, our view is that inflation will not stay at this elevated levels for an extended period of time, and hence the likely path for Fed, for us, from our point of view, would be keeping rates on hold. With that said, there is certainly a scenario where, because of recent escalation in Iran, oil prices moving higher, and the Fed hikes one or two times. Even if that was to happen, I think it's not necessarily a bad thing for fixed income because market is already pricing that, and investors can get yields, as I was mentioning, in a diversified manner in that 6.5–7% range that will do well even if the Fed was to hike one or two times. And I think that's kind of the important thing for investors to focus on.
It's interesting, this market has been nothing if not resilient, right? Even as we see kind of bouts of volatility with the AI and tech related to trade, the rotation. But broadly, there's been just a lot of strength and determination for investors to stay bullish. Do you think that masks underlying vulnerability, particularly when it comes to some of the credit risks that we still see?
Yeah, I think when we look at credit, there are certainly some areas of complacency that we are seeing. I think when we go down in quality, more deeper levered loans, even private direct lending, we are certainly concerned about potential future elevation or increase in default rates. So I think that's one area where we are certainly seeing that complacency. And then when we put it in context of other opportunities in fixed income, what we observe is that if we can construct a very high quality portfolio in that 6–6.5% range, investors don't need to go down in quality to pick up that incremental 1% or 1.5%. Instead, they can construct portfolios with that yield and not have that downside exposure to credit. And I think within that aggregate credit sectors, another area to also focus on is the software allocation. I think certain sectors of the market, particularly around private direct lending, even levered loans, you've seen exposures in the software space go higher. And if AI theme was to be successful, you could see some of those software names get disrupted. Yesterday's earnings from IBM kind of again highlighted what we are seeing, which is basically replacement of software expenditures or software expenses from corporates towards AI-related expense. And I think that will be an important theme impacting credit markets.
Yeah, tell us about how you'd prefer to be investing around the AI infrastructure build-out then.
Yeah, so I think the AI infrastructure build-out, for us, it's very important to focus on the downside scenario as well. When we look at what is happening in the AI space, we think that the distribution of outcomes is incredibly wide. As debt investors, we should focus on avoiding the downside. So what our approach has been to find structures where we have very good collateral, where we have very strong leases, and those leases are from very, very strong tenants, high-quality tenants, and then also where possible have residual value guarantees such that if the lease has to be broken, then the tenant is on the hook for providing the payment to the bondholders. And on that vein, we have found some very interesting opportunities over the last year or so. We did a very large transaction to support the build out of a data center in Louisiana, another one in Michigan. So being selective becomes very, very important. On the other side of it is also there is a lot of debt issuance happening broadly tied to AI, broadly tied to hyperscalers. And some of that is coming at very, very tight valuations, less protections for the bondholders. And it's important to avoid those as well, given the downside risks that those investments might have in the future.
Depending on where you look within the private credit space, things are either improving or we're still seeing redemption requests coming in pretty furiously. Do you see opportunities now, or do you think there's still systemic risk?
I think there are risks, but we are also starting to see opportunities that are getting created. I think if we go back a couple of years ago, there was a very, very high degree of complacency. There was very, very strong demand, and valuations had tightened quite a bit. They're still tight in most areas of private direct lending, but sometimes what you're seeing because of outflows that many of the private funds are experiencing, there are secondary sales that are happening, which investors can at times acquire at good valuation. So that's kind of one area of focus. Second area of focus is to provide financing because of these redemption requests. And we can provide senior secured financing at attractive terms that can be quite valuable for investors. And then when we go beyond private direct lending into the asset-based finance space in private markets, that's another area where the underlying credit quality is quite strong, quite good, and the valuations still offer good concession, good premium for investors to take advantage of the opportunity set.
Mohit, really great to chat with you. Appreciate your time with us. Mohit Mittal, who's the CIO of Core Strategies at PIMCO. Well, still ahead here on Inside, President Trump dropping plans to impose that 20% fee on cargo shipments transiting through the Strait of Hormuz just one day after suggesting that he would do so. We'll be bringing you the details next. This is Bloomberg.
You have Saudi Arabia, UAE, Qatar, Bahrain, and Kuwait, primarily, and then others. I spoke to all of them, and they would love to invest more money in the United States at record amounts, and that would be very acceptable. And this way, there's no fee.
President Trump there backing away from his plan to impose the 20% charge on cargo shipments through the Strait of Hormuz after US allies in the Gulf urged him to drop it. Let's get the latest now from Dubai. Our Middle East correspondent Abir Abu Omar joins us now. So we've seen the conclusion of another round of strikes against Iran from the US Central Command. We've heard President Trump talk about what he's planning for next week as well, despite, of course, taking this 20% toll off the table for now.
Yeah, good morning, Heidi. So we've seen a 7-wave attack happening. This is Central Command just moments ago saying that it completed the latest round of strikes on Iran, hitting military targets. It says that it is targeting targets in Iran that degrade its ability to hit commercial shipping in the Strait of Hormuz. Iran retaliating yet again against countries in the region, namely Kuwait and Bahrain. Kuwait reporting, and we reported this earlier, that 4 naval personnel there were injured. And so you're seeing the casualty count pick up in the region as a result of these attacks. But then perhaps the news from overnight and what we heard a little bit earlier is President Trump very quickly saying that he's taking away that 20% fee because he got from the region, that is the GCC, guarantees that they would invest more in the United States. He actually then said that he actually does not like the notion of a fee and he would much rather get investments from the GCC. So that's leading a lot of analysts to bring back this notion of taco or President Trump essentially backing away from claims that he makes. And again, this happened very quickly. Now, our own sourcing, Heidi, suggests that at least one regional government in the GCC has not agreed to essentially make further investments in the United States in exchange for this levy being revoked. And so still a lot of unclarity whether those countries, the 6-nation GCC body, will agree to making these pledges in the United States. A lot of them do not agree to the notion of Iran imposing tolls and fees on the Strait of Hormuz. That is what Iran said it will do once the negotiation period is over. But we reported weeks ago that most countries in the Gulf and a lot of countries in the EU have accepted the fact that this might be the case. But meanwhile, this is all happening when we don't have a lot of clarity still on whether the technical talks are set to commence. We're seeing these attacks pick up their pace. We still understand that the technical talks are very much on the table, just no time or date set out for them yet.
And arguably, this sort of short-lived threat of the 20% perhaps has planted the ability for Iran to be able to say, well, yes, we should be charging a toll for ensuring the safe passage of these ships, and that's exactly what the Foreign Minister has actually said, right? But I do wonder, we've also heard from President Trump in the latest interview talking about potentially some of the targets that he's looking at for next week.
Yeah, so again, the targets that the U.S. is aiming for over the next week include what the U.S. says are targets that would degrade Iran's ability to continue its attacks on the Strait of Hormuz. Now, it's unclear just what exactly those are. We understand from Central Command this morning that a lot of the targets that were hit in Iran earlier include defense hits on Iran, some weapon launchers. So similar to attacks that we've seen over the past week or so, Heidi. But at the moment, we're still seeing Iran still able to hit shipping in the Strait of Hormuz. And this is why you're seeing that over the past couple of days or so, traffic in the waterway coming to a near standstill. Now we're seeing either ships trying to go dark. This is what we've been saying ships are trying to do, just shut down their transponders and try to go. But ships are prone to getting attacked by Iran, and this has definitely been the case over the past 10 days or so. It all started with Iran hitting that LNG-laden ship in the Strait of Hormuz, and then just a couple of days ago, Iran hitting 2 UAE flagged ships, killing 1 person, injuring several others. And so Iran's threat on ships in the Strait of Hormuz is still very much there. That is what the U.S. is trying to combat. That is what the U.S., that is what Central Command is saying is trying to reverse the course of. And so we're seeing what impact that has on Brent crude prices that are slightly steadying today around $85 on the barrel.
Abu Ahmad, our Middle East correspondent with the latest. And next on Insight, Amova Asset Management CEO Stefanie Drews will be joining us. This is Bloomberg. Welcome back. You're watching Inside. Let's get you a quick look at where markets are standing at the moment. Big day for mainland Chinese markets as they head out to lunch. Japan also coming back online as well. When it comes to China, some really interesting data points out of that data dump. And I guess if you're more of on the China bull sort of side, you would be looking at the fact that the GDP deflator is seeing improvement for the first time in 3 years of deflation. Does this necessarily mean that deflationary spiral, and particularly for other economies, the impact of exporter deflation from weaker Chinese demand and higher manufacturing, is that really a story that is over, or whether that is really just a concentration when it comes to the jump in oil prices and the investment in AI as well? The other thing we're watching is, of course, an improvement in retail sales as well as industrial production, in particular that retail sales number giving really a little bit more optimism, at least from the near term, the monthly number that is, that perhaps we are seeing a bottoming out when it comes to the weakness in domestic demand, which has been such a drag on the broader economy. That drag, though, being seen by the GDP numbers coming in under the official range. Our next guest runs one of the oldest Japanese-founded asset managers, Amova, which was formerly known as Nikko Asset Management. Stefanie Drews is also the Global Asset Management Officer at Amova's parent company, Sumitomo Mitsui Trust Group. She joins us now in our Tokyo studio. Stefanie, really great to have you with us. Lots of cross-currents, of course, for investors to be watching, whether you're talking about the war, whether we're talking about the slowdown in China, the rotation when it comes to the AI trade in markets like Japan, Korea and Taiwan. What's top of mind for you on this trip?
Right now, I mean, there is so much. I'm not even sure where to start. But when it comes to the stories that are working for us, I think Japan is one of those that are really working, even in this complex environment. So you mentioned AI. Japan plays the AI game kind of one level down in the ecosystem. And there are very, very strong stories here in Japan on corporate governance, on accessing Asia through a very geopolitically stable country with enormous corporate governance reforms. And so in terms of opportunity, Japan definitely a huge one. You just mentioned China. And China is a very interesting market as well. And I know that GDP came in as it did, but China is a very selectively interesting story as well. And so while there are many dislocations right now and many geopolitical complexities, there are also really powerful stories still at play.
Tell us about the powerful stories that you see within Japan, because obviously Katayama's statements about what he wants to do when it comes to kind of the transformation for demand for government bonds, for example, the revival of GPIF and some of those reforms that are being perhaps not newly suggested, but certainly being drawn into the spotlight. How impactful is that likely to be?
So for the Japan capital markets, I mean, reforms have been happening for many years, and what you're just addressing is right kind of the end point of that, how GPIF should position itself. But in terms of Asset Management Nation, which is maybe what you're referring to, that kind of started really in 2022 with the Kishida administration when it launched the doubling of asset-based income plan. And the focus there was to take out of household assets, which were 2,000 trillion yen, about half of that is in deposits, and put that to work to the capital markets. And while we are positioning ourselves as a global asset management center, what really brought that money into the capital markets out of deposits was NISA, which is basically an interest-free, a tax-free vehicle that really triggered this move from deposits into capitals. So now that it's been a massive success, it reached its 5-year target within 3 years. The government is also looking at what is GPIF doing, and GPIF has been extremely successful with a very simple allocation of 25% across Japan bonds, equity, global equities, and whether or not pension funds like GPIF should be encouraged to have a broader allocation to Japan is now the question. Certainly international investors have been benefiting from the huge story that Japan is. And I guess what we're saying is also here in Japan, investors should benefit much, much more than maybe they're doing today.
Do you see the impact as being a significant one when it comes to both Japanese bonds and broader Japanese assets if we do see the changes with the GPIF and also, as you said, the inclusion in NISA?
So with NISA, it's already included. So NISA is basically an extremely open system where any fund that meets certain criteria can be put onto the platform. And we actually put 85% of our funds onto the NISA platform before NISA was even launched in January 2024. So we are definitely seeing flows into Japan equities, even domestically, although a lot of flows are going internationally, especially the US, because Japan is a market that doesn't really have a domestic bias, different from the US market, which has a heavy domestic bias. So we're seeing those flows already. But I think actually, would it make a big impact on Japan equities, for example? Maybe not so much, because there is such enormous international interest in Japan equities. So many institutional investors that are now creating country sleeves for Japan, pension funds that maybe hadn't looked at it in 30 years, now allocating research analysts to it, that actually we're seeing an enormous focus globally on Japan. And that's really what's driving this, this performance in the indices for the Tokyo Stock Exchange.
Tell us about the plans to expand into ETFs and why that's compelling for the Japanese market.
Okay, that's a very interesting story that has its own very peculiar complexity. So ETFs are a vehicle of choice for many retail investors around the world and also for institutional investors. Here in Japan, actually, the BOJ dominates the ETF market. So 85% of the Japan ETF market is actually the BOJ. So who's got the rest? Well, domestically, it's the regional banks that are investing into ETF, and they're doing that with great success. But Japan retail only has about 2% of its assets invested in ETF. So very, very big disconnect to what the rest of the world is doing. And the reasons are structural. Many people may not have a brokerage account, just a banking account, and they can't buy ETFs. And also, it's just much cheaper to buy passive exposure via an investment trust, which is a domestic mutual fund. And so that space still really needs to take off. There's also no tax advantage to doing ETFs. But we believe that this is a huge opportunity for Japan retail once we are able to shift perception, and also more people are opening online accounts and are trading stocks and therefore ETFs more freely.
Stefanie, I wanted to end with a little bit more of your worldview when it comes to China in particular. Obviously, this is no longer just a directional or binary growth story, right? Particularly in the absence of meaningful stimulus from authorities. So how do you approach the opportunities for a more nuanced Chinese market and demographic?
So China is an extraordinarily important market. It's the second biggest economy in the world. Investors do want access, but as you say, in the past it might just have been a GDP beta play. Today it's much more nuanced. So you want to be part of the new economy, which is basically the three greens, lithium, solar, of course, and EV. You want to be part of industrial robotics and AI hardware, and you want to be part of the massive infrastructure investments. And these stories are government supported, very powerful. What people are moving away from is the legacy economy, which really supported China for 30 years, which is basically, property and of course the weak retail segment driven by weak consumer spending. And so I think it's become that two-tier story that you can play into. Geopolitics is often mentioned, but actually geopolitics is fairly priced in China already. And the risk premium of geopolitics is actually less probably than the investment premium of that innovation that you can capture by investing into China.
Stefanie, really great to have you with us. We appreciate your time. Stefanie Drews, President and CEO of Amova Asset Management. We do have an alert just crossing the Bloomberg, some M&A action when it comes to the payment space. Stripe and Advent offering to buy PayPal for $60.50 per share. That's according to Reuters. So that values PayPal at just over $53 billion, according to the report. Stripe, along with the private equity company Advent International, making that offer. That was submitted earlier this month. It's backed by about $50 billion in committed bank financing. We've had no comments from any of the parties at the moment. We'll continue to watch that story as we get more details. In the meantime, take a look at how we're setting up when it comes to the start of trading in India. Just imminently, we are looking at potentially some pressure when it comes to the IT stocks and software space. We had the IBM results missing, so that could be an impact there. Staying on India, one of the country's most successful tech entrepreneurs planning to launch a new health tracking device. Deepinder Goyal made his fortune with delivery apps, including Zomato and Blinkit. He spoke to us exclusively for an upcoming episode of Latitude.
We will launch it as a wellness device with peer-reviewed studies and everything. And we have features coming up which will need it to become a medical device. So those features, whenever we have them, we will go through the regulatory approvals and then launch those features.
Is there a time frame you think it would be ready for the market?
We're not working on a timeline, to be very honest. Temple
24 months, 36 months.
No, it's not that long. I mean, I don't have that much patience. So
12 months.
Maybe 6 to 12 months. Maybe 6 to 12 months. But I've been saying that for the last 18 months. So I don't know, right? So every time I say it's like 6 to 12 months, but the deadline keeps getting pushed because we discover something new, we discover something richer inside the signal, and then we just want to make it perfect before we launch.
Also, now you have LAT Aerospace. What is that about?
LAT Aerospace is again a personal project / passion. Okay, so
what are you trying to solve?
I'm trying to solve for the hyper dense cities that we all live in. There's just too many people, and it's just too crowded. I mean, why do I live here? The reason why I live here is because we have so many people working here, and I need to be in the office every single day. But this makes our cities crowded and polluted, and so on, right? And the other thing is that our rural areas don't grow as much because nobody wants to set up factories there because it is so hard for CEOs to go there. Decongest the cities is what I really want to do, and sort of distribute wealth and work more across the country so that all of it develops at the same pace as the sort of cities are doing. That's what I want to do. What
would it take for that to be a reality? It's not just about putting $205 million into that project. What else needs to be in place for that to be a reality?
I mean, for that to happen, my idea of the answer is that we need short takeoff and landing planes, 8-seaters, running at super cheap costs. They don't need to be like as...
Super cheap is...
I mean, as good as trains, or maybe like twice of trains, like that much. That is the amount of ticket price of these planes. And you should be able to and create very small air stops in so many different cities, and towns and villages. So a hyper dense flight network is just, I mean, it's like almost quick commerce principles applied to aviation. So that's what we would want to build. It's a very hard project. I have 0.1% expectation that it will work.
Oh yeah? It's very hard because...
I mean, we can get the engineering done. Even that's hard. It's very, very hard. But then the regulations, and then finding real estate, and then it's a full stack airline, right? From building planes and having your own proprietary tech and having your radars and having everything on your own. There's nothing...
In a country that's already congested in the air as well.
I mean, I don't think there is any such thing as congestion in the air. Air is a big wide space. So if we build a routing system which actually lets all of this fly, I think everything can happen easily.
Deepinder Goyal there speaking with Bloomberg's Haslinda Amin. Well, coming up, as the FIFA World Cup reaches its climax, we dig into how the event has become a global commercial ecosystem of its own, with impacts far beyond the football field. More with Deloitte's James Walton is next. This is Bloomberg. Welcome back. You're watching Insight. Spain are through to the World Cup final after beating favourites France 2-0 in Dallas. They'll be facing off against either England or Argentina in Sunday's decider. Meanwhile, off the pitch, the 2026 tournament is set to become the most commercially successful edition to date. It's reportedly generated a record-breaking $2.8 billion in sponsorship revenue. For more, let's bring in Bloomberg's Balazs Pence. And so there's controversy from just about every angle, but that is one certainty, is that it is richer than before for FIFA.
Yeah, that's right. And in case you were wondering why FIFA decided to expand this tournament to 48 teams and why hold more than 100 matches spread across 3 different countries, that's your answer right there. Record revenue, which speaks to the appeal of the tournament, but also speaks to the opportunities presented by a larger tournament, by a bigger footprint, by the more games, by the hydration breaks that we are seeing now in the middle of every half of football being played. So obviously a huge commercial success, and that's probably part of the reason why we're hearing that FIFA is considering expanding the tournament even more for the 2030, the 100th edition, 100th anniversary edition of the tournament, which is going to be held across 6 countries and potentially with 64 participating teams. If you look at that chart of the revenues rising from tournament to tournament, you can see how FIFA is thinking maybe we can stretch that even a little more from that.
What are the implications of just the sheer numbers that we're talking about, right? The ticketing obviously was a massive controversy, and are there implications for the teams that are actually in the country that are actually able to participate?
Well, I think it's a commercial success. So from FIFA's side, there isn't much of a controversy. This has worked great. Even the controversies or the sort of minor scandals that we witnessed, whether that was over refereeing, whether that was, over the red cards, whatever the case might be, those generated conversation, those generated attention. And I think what we see is when you hold a tournament in a country like the US with Canada and Mexico as well, that gins up more attention, even in places where there may not be as much attention on the World Cup normally every 4 years. So for FIFA, it's a success. For the teams, it is a bit of a more grueling tournament. It's a longer tournament. They're playing more games. But for Spain and whoever comes out of the England-Argentina semifinal on the next side, that will matter a bit.
The audience numbers versus how often we see this event is quite an interesting dynamic, isn't it? What does this mean for marketing spend from sponsors then going into the next World Cup?
Well, I think we saw sponsors really being enthusiastic. That's always been the case. It's one of the most watched sporting events in the world. But right now they're getting more opportunities. And as we discussed, that bigger footprint with more countries participating. So they will probably just keep piling money into it. We're seeing an expansion of the sponsor base. This time, some of the hospitality and travel companies have been more active than previously. So we can probably expect that number to keep going up in the next editions.
Bloomberg's Balazs Pans there. Well, our next guest just came back from attending his 4th FIFA World Cup. Joining us to explore how this tournament has evolved into a global commercial ecosystem is James Walton, APAC Sports Business Group Leader at Deloitte. And James, it's interesting. I was just seeing a little bit earlier, there was a reel interviewing people that had, made a trip and an adventure out of going to the World Cup. And it feels like money is no object for some of these people that have gone along for the ride, right? What is it about this event in particular that drives this revenue? Because I do want to know why it's become even more lucrative than before.
So I think there's a couple of things. One is from a fan point of view. Most of us grew up watching a World Cup when we were younger, and the opportunity to actually attend, whether it's on your own doorstep or whether it's in an exotic location somewhere, the opportunity to actually attend a World Cup, say I was there, see all the action in the flesh, it really is a bucket list for many football fans. That's from the fans' point of view, but from the overall point of view, having a World Cup in a country like the US, which is clearly one of the best countries when it comes to activating sponsorships from a sporting point of view and from a financial point of view, this has undoubtedly been a success as you just set out.
Do you think then, in that respect, this is going to weigh into how future host countries are chosen?
Well, I think FIFA has been having a few issues with that over the last couple of years because there's been some locations, and we look at the recent World Cup in Qatar, the upcoming World Cup in Saudi in a few years' time, where it's pretty clear that money is in the basis of why that opportunity is taking part. At the same time, you have some perhaps established nations that have been bidding for World Cups on the basis of, we are an established football nation, that have not had the opportunity to do so. And it's pretty clear that FIFA's message now is that every World Cup needs to be bigger and better than the last. And what they're looking for from host nations is how are you going to help them to commercialize and help them to expand the appeal of the game.
Myriad grievances and controversies when it comes to FIFA, not just with this World Cup, but previous iterations as well, right? Does that have an impact on sponsorships? It doesn't seem to damage the broader brand of the sport at all.
I think over the last couple of years, and this goes back even before Infantino's time, even back to Sepp Blatter's time, there was various accusations leveled at FIFA, particularly around the process of how the World Cup was awarded. The Russia edition in 2018, the Qatar edition in 2022 were particularly under the spotlight. And at various times there have been sponsors that have said that they will be reducing their sponsorship or withdrawing from sponsorship. But at the end of the day, there is no other event that compares to the World Cup in terms of the opportunity that sponsorship presents. The Olympics is not at the same table. The Super Bowl is there, but the Super Bowl is primarily, obviously, a US focused event. So it is such an opportunity for sponsors that are willing to put their money there. And we have seen that sometimes money talks, and those decisions around whether or not to continue with sponsorship have been very much based on the ROI and the KPIs being met, perhaps sometimes rather than whether or not they truly felt ethically that this was the right direction.
It's interesting looking at just the stats, for example, concession takings, right? Some stadiums seeing near double what they make during an NFL game in the US. How do you think other sports, other codes might learn from this?
Well, I think a lot of sports are actually looking at the entire stadium experience in the US. There's been a lot of feedback from the fans who've gone, who are used to maybe European or South American football stadiums, saying, wow, the US stadium experience, particularly at places like the SoFi Stadium in California, is at such a different level in terms of how to engage with the fans. Things like the use of apps for buying your merchandise, buying your food and drink, the sheer number of concession stands. A friend of mine went to a recent game and said at any moment in the game you could go buy a beer and that you wouldn't queue for more than 1 minute, which is almost unheard of in European football stadiums. So I think the whole approach to merchandising, to the F&B experience, to the fan experience, will hopefully over the next couple of years have an impact on how football is consumed and watched around the world.
Does this distort or change the I guess, fundamental structures of the game and of talent development and evolution? Because you've obviously got homegrown grassroots countries where it is already a strong sport versus perhaps other economies, other countries that would be looking to import talent for a quick fix. Is that going to become more tempting the more lucrative this sport gets?
Oh, I mean, definitely. I think we're seeing more and more pressure in some of the kind of fringe countries, the developed nations that perhaps think that they should be at a World Cup. There's a lot of pressure as to why they are not qualifying. Look, the expansion from 24 to 32 to now 48 and potentially 64 nations helps in that regard, because suddenly you're having more African nations qualify, more Asian nations qualify in particular. The new places are skewed more towards those areas. And that then gives an incentive for those countries to invest, to try to qualify for a World Cup with everything that comes to it, in a way that perhaps knowing with only 32 teams that they wouldn't qualify. So I'm expecting that if the announcement does come of 64, that it will mean countries, if you look in an Asian point of view, countries like Thailand, Vietnam in particular, China will be looking and saying, you know what, with 64 nations, we should expect to be there, and that will lead to more investment at whatever level that is.
James, really great to have you with us. We appreciate your time. James Walton, APAC Sports Business Group Leader at Deloitte. That is it for Insight. Horizons Middle East and Africa is up next. Keep it here with us. This is Bloomberg.